Okay, so chapter 25, we're continuing on the macro portion of the book. We are going to measure domestic output and national income. Okay, so national income accounting helps us measure the economy's overall performance. The Bureau of Economic Analysis is the bureau that does compile the national income and product accounts. And why do we do this? Essentially, what we are calculating is GDP, gross domestic product. And just like we look at a business, how much does a business produce? For example, how much are they producing this time period versus last time period? Are they producing more? Or even as a person or a household, how much income did a household earn? You know, it kind of gives you an insight of their standard of living and how well they're doing. So when we look at what the economy as a whole produces, this helps government to look at the health of the economy and also help formulate policy. If GDP is declining, then we could be in a recession, and we want to formulate policy that can help bring us back to growth again. Okay, so when we look at counting products, first we need to look at the definition of gross domestic product. Okay, and this definition is very important, and we definitely need to note it because you will see GDP referenced many, many times, and it's easy to be like, okay, what exactly is GDP again? Okay, so it is the market value of all final goods and services produced within the borders of a country during a specific period of time. Okay, so whatever is produced within the US is counted in US GDP. Okay, so if a US citizen goes to Germany and opens up a donut shop, that is not counted in the US GDP because it is not produced within our borders. It is counted in Germany's GDP. Okay, so it is all the goods and services, okay, the final goods and services that are produced within our borders in a given period of time. So normally when you see GDP quoted, it's either quarterly or yearly. Okay, so quarterly is every 3 months. So first quarter is January through March, second quarter, April through June, third quarter, July through September, and fourth quarter, October through December. Okay, so again, when we looked at the definition, we said market value of all final goods and services. So we look at what goods are sold as in, for example, the store. So if I were a carpenter and I made and sold tables, okay, what is counted in GDP is what I sold the table for. Okay, I do not include the cost of the wood directly. It is already implied what I sold the table for. So if I paid $200 for the wood, I sold the table for $300. Okay, that $300 that I sold the table for should already include all the cost of the material and labor. So in this case, let's say $200 for the wood and $100 for my labor. Okay, if we were to count what I sold the table for and the cost of the wood, then we would be double counting, and we don't want to do that. So we can either count what we sold the final good for in the marketplace, or we can also look at value added. Okay, but we don't count intermediate goods. And intermediate goods, in this last example I gave, is the wood, but they are goods that are used in the process to make the final good. Okay. All right, so we can look at an example of when we can calculate the final value of the good using value added. Okay, so the sheep rancher sells the wool to the wool producer, okay, for $120. Okay, so that was the original value added. The wool producer then does some improvements and then sells it to firm C, the coat manufacturer, and the improvements there, the value added is 60. And the coat manufacturer to the clothing manufacturer sells it. And of course, the coat manufacturer also does some improvements, and the value added there is 50. And then at the end, we sell it to the retail, let's say Macy's, okay? And from firm D to firm E, the value added improvements is 80. And so you can see here that the total value added is 350, okay? And that is also what we sold the coat for. So we can either look at what the coat sold for at Macy's, or we can do the value added method. Now, if we were to count the sale values of materials or the product in each stage, then the total we would get is 1140. Okay, but this would include double counting over here. Okay, and so we don't want to double count. Okay, because sheep rancher sold it to the wool producer for 120, the wool producer to the coat manufacturer for 180, etc. But this is already including the original value and the value added. Okay, so we are double counting here, and we don't want to do that. Okay, so what will go into GDP is the 350, not the 1140. Okay, so what does GDP not include? Okay, so public transfer payments, this would be, for example, welfare payments. These are a transfer of income to one person to another person. So it is not the market value of all final goods and services. It's just a transfer of income. Social security payments, any type of stock market transactions, buying and selling of stocks. Also, any Christmas money that someone might have given you, or any type of allowance money your parents might have given you, or you might have given your children. That's private transfer payments. Again, that's a transfer of income from one person to another. It's not actually producing a good or providing a service. And also it excludes secondhand sales. So, if you're selling your used stuff, okay, that also is not included in GDP. Okay, what's included in GDP is, for example, let's say you bought a car brand new, whatever time period that car was manufactured in, okay, it was included in GDP in that time period. But you selling your car to your friend, okay, that's not an actual production of a new good or providing a service, so that is not included in GDP. What GDP looks at is production of goods and services in a time period. Okay, and there are two approaches to calculating GDP. The first approach is called the income approach. Okay, and so this is where we count wages, rental income, interest income, and profit, because these are all income that is derived from production. Okay, and then there's also the expenditure approach, and then this is where we count the amount of money spent buying the final goods over here. So let's look at each a little more closely. Okay, so the income approach on the right, this would be wages plus rent plus interest plus profits plus any type of statistical adjustments needed. And then on the left is the expenditure approach, and this is, like we said earlier, is the money spent on buying these goods. So it would be what households buy, what businesses buy for investment purposes. Again, just a note, investment here does not mean financial investment. We're not buying stocks and bonds. This is where we're buying capital equipment, factories, etc. And then what the government purchases, and also net exports. Okay, so net exports is exports minus imports. So imports do not count in GDP. Why? Because the goods were not produced within U.S. borders. Okay, they were produced in foreign borders. Okay, but it does count exports. because exports were produced within the U.S. Okay, so let's look at the expenditure approach a little more closely. Okay, so consumption, this is what households spend on goods and services. So this is when you go to the grocery store and you buy your milk. Okay, this is when you go get a haircut. That would be consumer expenditures for services. Okay, durable goods would be, for example, your cars, your furniture, goods that are expected to last 3 years or more. Non-durable goods are goods that are expected to not last for 3 years, so basically less than 3 years of life. Okay, let's move on. Okay, gross private domestic investment. This will be denoted with a capital I and a small g. Okay. So again, just a little bit of a reminder here that non-investment transactions excluded. Okay, so buying stocks, buying bonds, that's not included in this category. Okay, but this is if a business acquires more machinery, tools, equipment, okay, that will go under investment. Any type of constructions, and also inventories. Inventories are goods that are produced but not yet sold. Okay. So this is the category that they go under. So any new cars produced but not yet sold, okay, will go under investment. If a car is produced and sold within that time period that it's being counted, let's say a household buys it, then that will go under consumption. But if the car is produced but not yet sold, it will go under investment. And also any type of money spent on research and development. If a pharmaceutical company is spending money on the development of a new drug, okay, and researching it, that will also go under investment. Okay, so what is included in GDP is what we saw in the previous slide, which is gross investment. But I want to talk a little bit about net investment, and net investment will be denoted with a capital I and a small n by it. Okay, and so it's gross investment, how much we spent on, equipment, machinery, tools, or rather businesses spent on machinery, equipment, tools, all construction, R&D, etc., minus depreciation. Okay. And what essentially depreciation means here is the amount of capital that is used up over the course of a year. Okay. And so if it's still positive, then we have net investment. If they're equal, okay, then over there we say it's zero. Net investment is zero. But if it's less, then that means if net investment is negative and that the economy is using up more capital than it is producing. Usually this happens during very hard economic times when demand for goods and services is low, so companies are not acquiring more capital equipment. They're not spending money on construction, and the current capital that they do have is depreciating at a faster rate than what they are accumulating for new capital. But when we look at GDP, all we look at is gross investment, which was on the previous slide. Okay, we do not count net investment. Okay. The other category is government purchases. So this is when the amount that government spends for goods and services, and also for publicly owned capital. So government buys land for a new school, that's under government purchases. Government buys desks for the new school, that's under government purchases, etc. This does not include, again, transfer payments, and that's, for example, Social Security payments, welfare. Once again, it's a transfer of income from one person to another. And then our last category is net exports, and this is we add exports to GDP and we subtract imports from GDP. Why? Because imports, again, were produced in another country, not within the U.S. border, so it's not included in GDP. Okay, so using the expenditure approach, GDP is C plus I plus G plus XN. Okay, this is a very, very important formula to remember, and it will come in handy pretty much for the rest of the course. All right, so just here, if we look at the accounting statement for the U.S. economy in 2012, okay, if we look at the expenditures approach, our biggest category is personal consumption expenditures. It ranges from 60 to 70. And personal consumption expenditures is about 70% of GDP, so we are definitely a very consumer-driven economy. Not all countries around the world have 70% of their GDP depending on personal consumption expenditures. And then we have domestic investment over here, and then government purchases, which is slightly bigger than domestic investment, and then net exports. So the U.S. has negative net exports, meaning we import more than we export. So it does detract a little bit from gross domestic product. So we have here that our gross domestic product in 2012 was about 16 trillion. And if we look at the income approach, we can see wages, rents, interest, proprietors' income, corporate profits, etc. And then we have national income, less net foreign factor income, but we also add in statistical discrepancy and consumption of fixed capital. Okay, but they should both be equal. Okay, the amount that they get is equal. It's just two different ways of counting GDP. Okay, and if we can look at the GDP different nations. So United States has the biggest GDP out of any country in the world. That is why we are called the economic superpower. China recently surpassed Japan. And up until recently, Japan was number 2. Now it's China. Now remember, this is not GDP per capita. Okay, if you look at GDP per capita, China is much lower than Japan's, their living standards. This is just a total, a look at total GDP. And we go, we can see Germany, France, Brazil, United Kingdom, and then all the way down. Okay, so let's look a little at the income approach. We had some fancy words a couple slides back, so let's talk a little bit more about what they mean. Okay, so the biggest category is compensation of employee. Basically, it's wages and salaries that businesses and government pay to their employee. Okay, and this also includes wage and salary supplements, so such as payments by employers into Social Security, and also just into a variety of pension, health, and welfare funds for workers. Okay, rents is the income received by households and businesses that supply property resources. So for if you're leasing a house, that payment made to the landlord, that goes into the category of rents for the income as well. Just a little side note that when we look at rents here for the national account, we look at net rents. It's a gross rental income minus depreciation or rental property. Also, we look at interest. Okay, interest is the money paid by private businesses to the supplier of loans for capital. So if a company took out a $5 million loan at 5% interest to expand their production, okay, that 5% interest that's being paid by the company goes into GDP under the income approach. Also, proprietor's income. Okay, this would include, for example, businesses that are technically a partnership or a sole proprietorship. Basically, you're owning your own business, etc. And then corporate profits. Okay, so whatever a corporation earns in profits, and there's 3 different categories here. Okay, so corporate income taxes, so what the government makes these corporations pay in taxes, they flow to the government. That's counted in the income approach. Dividends, okay, and dividends are the after-tax profits that corporations chose to pay out to their stockholders. So they flow to households, which if you are a stockholder, then technically you're a part owner of the corporation. And then also undistributed corporate profits, okay? And so these are any after-tax profits that are not distributed to shareholders, but are saved or retained by corporations to invest later into new plants and equipment. Okay, so they might save some of their profits to help build a new factory, for example, or to expand operations, or to build a new operation center. Okay, and also taxes on production and imports. Okay, this includes just general sales taxes. And whenever you buy a shirt, usually there's a tax that you have to pay. So, you know, the shirt's $100. Sales tax might be, let's say, 8.25%. So you pay another $8.25. That sales tax, that $8.25 goes into the government. It's counted under the income approach. Any type of excise taxes, business taxes, fees, customs duties, etc. Okay, so when we look at the expenditure approach, we subtract imports from GDP because they are produced in another country. Okay, so here to keep it consistent, we subtract net foreign factor income. Okay, so what exactly is net foreign factor income? Okay, so we take out the income that Americans gain from supplying resources abroad, and we add in the income that foreigners gain by supplying resources in the United States. Since the resources are technically within U.S. borders, and that income that foreigners gain will be added to national income, and what we take out is what Americans gain from supplying resources abroad, because those resources are not within U.S. borders. Okay. Consumption of fixed capital. Okay, why do we count the consumption of fixed capital? Because a lot of capital, continues to produce profits year after year. So the bakery oven that was purchased, and let's say in 2011, helped produce bread, which helped earn a profit in 2011, but it's also helping the bakery earn money in 2012, 2013, 14, 15, 2016. Okay, and so they want to definitely include that, and also to essentially, this is essentially the allowance that is going to be used to pay for the ultimate replacement of those goods as well. Okay. Statistical discrepancy. Okay, so essentially, as we know, the expenditure approach and the income approach must equal each other, but it's impossible to get it perfect to the last dollar. So then we adjust using statistical discrepancy. So for example, in 2012, the discrepancy was 17 billion, which sounds like a lot, but it was actually less than 0.5% of GDP. And that helped equalize the two numbers. Some other national accounts. Net domestic product is simply gross domestic product minus the consumption of their fixed capital. It simply is GDP adjusted for depreciation. Okay, and it also shows how much government and businesses and households can consume in the years without limiting its capacity to produce. Okay. National income. Okay, this is how much Americans earn for their contributions of land, labor, capital, and also entrepreneurial talent. It's the entrepreneur's idea that gets land, labor, and capital together to produce a good or provide the service. Okay, so we look at that, and it subtracts the statistical discrepancy. Okay, and we add in the net foreign factor income. Okay, and this is again the income that is earned by Americans overseas minus the income earned by foreigners in the United States. So over here, national income essentially is what Americans earn for working, acquiring capital, land, and for their entrepreneurial talent, whether it's here or abroad. Okay. Personal income is all incomes received. This is a little bit different because it also includes transfer payments. Okay. But it subtracts taxes on production and imports. It subtracts Social Security contributions. It subtracts corporate income taxes. It subtracts undistributed corporate profits. Okay, this is personal income alone. Okay, so it's national income, what we learned from land, labor, capital, or talent, plus transfer payments, and that's it. And then disposable income. This is the amount of income that households have after they're done paying their personal taxes. So you might earn $50,000 dollars a year, but after taxes, including you're done paying your income taxes, property taxes, maybe any type of inheritance tax. Let's say you have $40,000 left. That would be your disposable income. Okay, let's look a little bit at the circular flow. We have U.S. households here. Okay, so the orange, we look at a little bit more of the expenditure approach. So we have personal consumption expenditures, which then flow, it goes part of GDP. So whenever we go spend money on coffee and let's say new shoes, okay, that goes to the company. They use that to pay employees, rents, income. They pay their shareholders dividends, etc. Okay, and that all, some of those taxes flow towards the U.S. government. Some of it go as personal income to the employees of these company. And then once they're done paying their taxes, that once again flows back to the U.S. government. The disposable income goes back to the U.S. households as well. U.S. government, whenever they spend money on goods and services, once again, it flows, as you can see, back to the companies that they spend their money on. Once again, they pay wages, rent, interest, dividends, etc. Then it flows back to households. And once they're done paying taxes, actually flows as personal income. The taxes go to U.S. government. The disposable income goes back to the households. And same with U.S. businesses. Whenever they spend money on capital, so one business buys a tractor from another business. Okay, the business that they bought the tractor for gets some income. They pay their employees rents, interest, dividends if they're a public company, and it flows all the way back again. Okay. All right, so we're going to look at nominal GDP versus real GDP. Okay, and so GDP, when it's stated, is the market value of all final goods and services in a given period of time. Okay. So GDP is a dollar measure, but it does create a little bit of a problem when we look at current GDP, because current GDP includes current year's prices and current year's production quantities. Okay. And why is that a problem? Because when prices and quantity is changing at the same time, we don't really know how much of the growth is attributed to a change in quantity and how much of it is attributed to just price is changing, and essentially inflation. If prices are going up, that's inflation. Okay. Whereas real GDP, what we do is we pick a base year and we use those base year prices for all the years after. Essentially, prices don't change, because if price is staying the same, then we can look at solely the change in quantity, and then we can really see how much the economy is producing from one quarter to the next, or from one year to the next. Okay. So we're going to use a price index to determine real GDP. Okay. Why do we use a price index? It's much easier to simplify big numbers in the trillions to just smaller numbers, and that way we can play with them a little more. Okay. So price index will be the price of a market basket in a specific year, divided by price of the same basket in a base year times 100. Real GDP is going to be nominal GDP divided by the price index. Okay, let's do. We can also look at this as nominal GDP divided by real GDP. Okay, so we're going to calculate real GDP here, and we're going to say the base year is year 1. Okay, oftentimes the base year is stated as the earlier year, but be careful, because sometimes, they'll say the base year is year 3, and you would want to use year 3 prices, not year 1's. Okay, but in this case it is year 1, so let's look over here. Okay, so let's just say the economy only produces pizza. Okay, simplify things very much so to help get the point across. Okay, so year 1, okay, there were 5 pizzas produced. Each pizza was $10. Okay, so if we go back to our formula, okay, the market basket for year 1 for nominal GDP, it's $50. Okay, because a basket is, we have several commonly bought, items, and in this case, since we're only producing pizza, that's our commonly bought item, so it's 50. And also using year 1 prices, since the price in this case doesn't change, it's also 50. So the index will be 1, but we multiply it by 100, so the price index ends up being 100. Okay, for year 2, okay, we produced 7 pizzas, but the price of pizza went up by $20. Okay, so over here we would have price of the basket and current year, which is $140. And we would divide it by the price of the basket in base year. Okay, so this is what we do. Okay, we didn't say we use. Okay, we didn't say we use base year prices and quantity. We're just going to use base year prices. Okay, so we're going to multiply 7 current year, so this is year 2 outputs, with base year prices of 10. Okay, so 7 multiplied by 10 gives us 70. This will give us 200 for the price index. Okay. For year 3, okay, we produced 8 pizzas at $25 a pizza. Okay, so nominal GDP, 8 times 25 would be 200. Okay, but if we look at real GDP, okay, so real GDP is current year's quantity or output multiplied by base year prices. Okay, it's going to be 8 pizzas times $10 a pizza. Remember, we're using base year price of $10 for real GDP. Okay, so what we would have here is 200. Okay, and then we will sorry, trying to get my pen to work here. Okay, the base year market basket of 80. All right, and if we were to multiply this by 100, we would get a price index of 250. Okay, so when we look at nominal GDP versus real GDP, okay, you can see that here nominal GDP is much higher than real GDP, and that is because nominal GDP is measuring the change in price and quantity, whereas real GDP is just looking at the change in quantity or output of pizza. Okay, so it is easy to accidentally mistake that the economy is growing much faster than it really is when you look at nominal GDP, because when prices rise at the same time as output is rising, it leads to a much greater change than if we keep price the same and just look at the increase in output. So real GDP, in other words, gives us the real picture. Okay, I want you to pause this for a few minutes and try to figure out year 4 and 5. Okay, so let's work out years 4 and 5 over here. Okay, so year 4, unadjusted nominal GDP. Okay, this would be 10 pizzas times $30 a pizza. So this would be 300. I apologize. I did not mean to use this quite this. Okay. Let's calculate nominal GDP. So $10 a pizza times $30. 10 pizzas times $30 a pizza gives us a nominal GDP of 300. Okay. If we were going to look at real GDP, okay, then it will be 10 pizzas times $10 a pizza. So this will be 100. All right, so number 4 divided by number 5 times 100. That's 300 divided by 100. Gives us 3 times 100. So the index will be 300. All right, and let's do year 5. So nominal GDP will be 11 pizzas times 28 pizzas. Okay, and that gives us a nominal GDP of 308. And we have for real GDP will be 11 pizzas times $10 a pizza. And that is 110 for real GDP. Okay, so 308 divided by 110, okay, gives us 2.8 times 100, and we have 280 over here. Let me fix this 8. Okay. There are some shortcomings of GDP. It does not take into consideration non-market activities such as housework that you do for yourself. It doesn't take into account leisure time, improved product quality. So if you notice, technology has been getting better, but also the price has been getting cheaper, or at least year after year, something might stay $100, but the quality of it is getting better. And so like the $2,000 computer today is a much better computer than the $2,000 computer was 10 years ago. Also the underground economy, so illegal activities essentially, it doesn't take into account quality of the environment. Also, when it says composition and distribution of the output, it doesn't show income equality or income inequality. It doesn't show that if GDP is pretty evenly distributed to everyone, such as the Nordic countries, such as Sweden, for example, or if there is a high level of income inequality where there's a lot of rich people, a lot of poor people, but not so many people in between. And also non-economic sources of well-being, like I guess the value of meditation or exercise. Okay. If we were to try to put it, the underground economy into GDP, try to take into calculations illegal activities, you could see in Mexico it would be about 32% of their GDP. Okay, South Korea 27 about, and you see the United States it's about 7-8%. Okay, and so some of the sources of the data, you could see it over here. You can go on these websites and find them. And just more over here as well. All right, and this concludes chapter 25.